Uh, a very warm welcome to everyone who's joining us today to talk about some key trends and in terms of the outsourcing market, some deal pricing trends, and some what are we seeing in terms of the market in terms of deals, in specifically in the EMEA market. So, Milan, if we move a couple of slides forward to the agenda one. Today, the key discussion points will be centered around. Okay, we're going to start. We're going to be starting around with what is the overall macroeconomic environment looking like? What's the current state of the market? Highlighting some of our key observations. We'll then go ahead talking about some of the key pricing trends and our outlook for Europe for 2025. We'll also talk a bit more about how are what are enterprises expecting from their service providers, and then accordingly, what are contemporary outsourcing deals looking like? So we'll talk about themes such as offshoring, we'll talk about DORA, we'll talk about GCCs. So fair bit of content to cover in terms of what's trending in the market. And of course, as Milan mentioned, please, if you have any questions, please feel free to put it in the chat box and we'll definitely try and take it up as part of the event today. Or else, if we are not able to take it up, we'll definitely get back to you offline with our responses. So with that said, let's get started with the first agenda item, which is the current macroeconomic situation of the market. So right now, the market is in a situation as what we are characterizing as the three C's of the market, right? So the three C's standing for contraction, competition, and consolidation. So when I talk about contraction, I think we are mainly talking about sort of the reduced discretionary spending that's prevalent in the market right now due to macroeconomic situation. We're also seeing fair bit of evolution in terms of how clients are expecting from their outsourcing partners, a fair bit of insourcing happening, automation, of course, reducing the amount of manual labor needed or manual people needed, right? So that's also disrupting the industry. So that's essentially shrinking or contracting the overall sort of the sort of the pie of the market. The market is also currently characterized by intense competition. Of course, given that we are in a market which is sort of seeing a fair bit of discretionary spending curbs, competition is going to be intensely high, right? So, and along with that, we are also seeing emergence of tier two specialist providers. We're also seeing consulting heritage providers, right? Providers who traditionally did not do managed services also get into start offering managed services and IT services. And then finally, I think a fair bit of vendor consolidation happening in the market. And the key objective really is to drive cost optimization. Of course, we'll talk a bit more about how that's impacting the market. For instance, given these three themes that are prevalent in the market, we're definitely seeing a fair bit of predatory pricing, which we probably expect will stay for the sort of the foreseeable few quarters. There's a fair bit of margin erosion for service providers as well, which is driving prices down. There is, of course, lesser opportunities in the market, which is also leading to sort of very aggressive and more pricing pressure, of course. And then, of course, this is all not all dooms, because we also talk about how our service providers actually managing that situation, because we see a fair bit of growth also coming back in the market. Service providers reporting better numbers in the previous quarter. So how is that possible, right? Given that all the doom and gloom that we've spoken about. So there is a fair bit of opportunity coming through in terms of vendor assisted GCC setups, in-demand skills, be it data, AI, SAP, cloud, cybersecurity. So there's fair bit of demand in those areas. We're seeing providers getting very innovative in terms of the financial engineering and commercial constructs that they're bringing to the table, and they're also trying to grow the overall managed services portfolio. Um, so this is just a glimpse in terms of what we're going to talk about over the next 45 minutes. So let's get rolling. Let's talk a bit more about how the market has moved. So, for example, we kind of till the previous quarter, we saw kind of 9 consecutive quarters of declining growth, not necessarily a shrinking market, but a declining growth starting from the quarter of September 2022. However, I think the previous 3 quarters actually were the time when the industry started shrinking or showing a declining growth. But now again, we're starting to see some green shoots. The September quarter for a lot of organizations has been positive. No, I wouldn't say very positive, but has been positive. And you see, it has started to sort of go back into the positive territory. As a firm, we are now predicting. We're now predicting that for 2025, the market is expected to grow between anywhere between 4.5% to 5%, which is again not something to which, so of course it'll be a soft landing for the market per se. So definitely emerging positive signs out there for the industry as a whole. If we kind of double click on it and talk about how that market, how that is evolving, if you look at the next slide and talk about how that is trending by geographies, both there is both a recovery both in terms of North America and Europe. And even if you look at the recent reports that were reported by a lot of service providers, there was most of the service providers largely reported certain positive growth in Europe. Only a few firms have reported a decline. However, the decline has, in Europe has also been much lower compared to the previous quarters. So fairly, it's overall positive. Again, there are some headwinds expected in the European automotive segment. So that's going to that is expected to impact a few service providers, given all of that, what is conspiring in Germany and some of the other markets. I think as a base, rest of the world seems to be the strongest performing market in terms of percentage growth. But given that it occupies a much smaller share of the share of the market pie at a smaller base, but it's still a significant market for us for certain service providers, and that's where you see a lot of growth coming from. So again, I don't think this conversation will be complete without talking about GCC. So if we move on to the next slide and talk a bit more about GCC. So I think this has been the headline conversation this year, right? A fair bit of activity on the GCC front, nearly 300 center setups in 2023. We're again counting almost a similar number or more than that in 2024. Of course, we'll have the results out soon in a few weeks in terms of how 2024 conspired, but again, it looks very positive. So this makes the approximate total number of GCC centers as of July 2024 about 5,200. Now, these 5,200 centers deploy nearly 2.5 million employees across all of these centers. The overall market size being about $80 billion. And of course, Asia Pacific continues to sort of occupy a major spot in that, with nearly 47% of the centers being in Asia Pacific and 35% of them in nearshore Europe, with the rest cluttered across LATAM, North America, and Africa. Um, as I said, 300 new center setups in 2023 and 4 to 6% growth in GCC headcount. So it's not just about new GCC center setups, but also a fair bit of growth coming in these existing center setups. So that's also a trend in the market. So I think what we are currently seeing is new adopters continue to dominate captive center setup activity. In fact, we had a first user conference in Dallas about a month and a half ago, and GCC I think was one of the most common themes that everyone spoke about. I think 4 out of 5 enterprises that I spoke with or we spoke with, all of them said that they are in the process of thinking about a GCC and already kind of in advanced stages, or they are already in the process of actually right now in the process of setting up a captive and center setup either in India or nearshore Mexico or somewhere in Europe. So that's why it's dominating the headline so much. And of course, India continues to be the new leading destination, sort of the leading destination for new center setups. So I think given that we're talking about GCC, this conversation again will not be complete without talking about the bot construct, right? Because I think this year we've seen a fair bit of activity for, especially in terms of the opportunities that are available for service providers, is to be able to assist certain organizations in terms of helping them set up the captives through a bot model. So Pratik, can you talk a bit more about what are your observations specifically with respect to the BOT model?
Absolutely, Ricky. And I think before I jump onto the bot model, it's important to also highlight the other model, which is the captive, assisted captive, right? Both assisted captive as well as BOT or build, operate, transfer are essentially part of the vendor assisted GCC setup strategies. And among these two, if I were to restrict myself to BOT setup, I think that's an area which is witnessing immense growth. There are multiple reasons why we are seeing this. First and foremost is lower upfront financial commitment. The enterprises do not want they essentially want to minimize the capex. So the BOT model helps them in lowering that upfront cost. The vendor assisted BOT setups also help them ease of setup and management. And everything put together accelerates the overall GCC setup. So GCC setup via BOT model is clearly gaining huge traction. All in all, this is one of those spaces which is presenting an exciting opportunity for the service providers out there. I think on the next slide, we have another interesting trend observed in the European market. And Vaibhav is going to cover that. Over to you.
Sure, thanks, Prateek. So in Europe, the financial firms specifically are working against the clock to strengthen their IT systems, as the deadline for European Union's Digital Operationals Resilience Act, or DORA, is getting closer. So DORA is basically a regulation designed to help financial institutions better handle IT risks and also stay resilient during disruptions. So let's break down its impact on IT services. First, to comply, firms are upgrading their infrastructure to ensure they can continue operating during any disruptions, which is kind of increasing costs. Also, firms are adopting advanced systems to monitor, track, and report incidents, driving up compliance expenses. Third, financial firms are carefully reviewing and auditing their service providers to ensure they meet DORA's requirements. Fourth is that firms have enhanced cybersecurity spending by investing in advanced tools to tackle cyber risks. And the last impact is that providers now face stricter service expectations with tougher SLAs and harsher penalties for non-compliance. I think this brings us to the end of this section. Let's move on to the next page. Now that we have covered the broader market trends, let's focus on pricing movements for IT skills over the past year. Next slide, please. Overall, the pricing has stayed mostly flat over the past year as enterprises focus on cost optimization in tighter budgets. So standard IT skills, which includes technologies like .NET, Java, storage, and databases, prices have remained flat or even slightly declined in most regions. On the other hand, specialized IT skills such as full stack development, AI, ML, IoT, and cybersecurity, they have experienced steady growth in pricing due to their high demand and scarcity of talent. Pratik, shall we engage the audience with a quick poll now? I'm really curious to see how everyone views the forecast for FT pricing over the next year.
Absolutely. So it's poll time. And the question is, according to you, how will the rate cards or FT pricing for standard IT skills change in Europe over the next 12 months? And just to reiterate, standard IT skills essentially include .NET, standard Java, C++, etc. So do you think it's going to be a very negative outlook, which means a reduction of more than 2%, or a negative outlook, which essentially means more or less the rates becoming stagnant, or a positive or a very positive outlook? So the poll starts now. I think we can give a few more seconds. Okay. So more or less, the trends are suggesting a normalized distribution. Ricky, what's your opinion? Is it anything
Yeah,
surprising from the results?
absolutely. I think not at all surprising. We are also expecting that pricing is going to largely remain in that flattish territory, probably flat to slightly decline for some of the more standard skills and slight increase on some of the more next gen skills like cloud and cyber and all of those. But absolutely, I think to the point in terms of what we are also seeing and expecting for the next year.
Absolutely. If we jump on to the next slide, we are going to talk about our overview as to what are we expecting in terms of the pricing shift over the next 12 months. So Ricky talked about the three C's earlier during the earlier part of the session. And while we are witnessing some green offshoots in the overall industry recently, the FT pricing increase is expected to remain muted even in the next 12 months. And there are two primary reasons why it is expected. One is the continued increased competition, right? And as we speak, we are seeing more and more instances of service providers safeguarding their top line at the expense of margins as well, right? So that's a That's one of the emerging trends. The other trends that is attributing to this stagnancy in the FT rate card is in terms of higher expectation from buyers, right? We all understand that this is buyers market, which is also kind of contributing to some bit of a downward pressure on the pricing. At an overall level, if I were to talk about numbers, right, onshore as well as nearshore, Europe is expected to remain stagnant, especially on the standard skills front. On the premium skill side, we will expect some higher increase too, albeit it will be way lesser compared to what we had observed back in 2022 time frame, right? For offshore, our expectation is that the pricing might go down in a few areas. And one of the major reasons is the forex decline, right? That is expected to continue over the next 12 months. Okay, with that, I think let's come on to the exciting offer that we have for you. So it's a complimentary price check that we are offering to you. So complimentary price checks on 3 roles from a set of 3 functions, and you also have a flexibility to choose any 3 locations out of 6 locations. So you can use the link given in the chat to request the access. This price check can essentially help the attendees from the enterprise side in assessing whether the pricing that they are paying to their vendors align with the market norms or not. On the flip side, for attendees from the service provider organization, this complimentary price check can essentially help in the overall guidance as to where they stand vis-a-vis the market norms. Okay, with that, now that we have seen the historical trend as well as outlook in terms of FT pricing or the input pricing, let's hear from Vaibhav on his views in the movement on the output-based pricing or transactional-based pricing front. Vaibhav?
Yeah, thank you, Prateek. So over the last 3 years, we have observed a notable reduction in TCV or total contract value for managed services deals, shrinking by 15 to 23%, despite an increase in underlying costs. So this trend is evident across both infrastructure and application development and maintenance deals. So I think there are several key drivers behind this. Number one is offshoring. The industry now sees 90 to 95% offshore leverage as the new standard for cost optimization. Second is automation. So with better automation tools, providers are achieving more with fewer resources. Third is leveraging low cost locations. So increasing use of tier 2 and tier 3 cities in India is helping providers offer more competitive pricing. I think last is increased competition. So we know the entry of big four firms, OEMs, and tier two service providers has intensified the fight for deals, forcing providers to adopt more aggressive pricing strategies and overall go very aggressive in their solution construct. So I think these factors are reshaping the managed services landscape, compelling both buyers and providers to rethink how value is structured and delivered. Moving to the next slide. Let's now explore broader enterprise expectations and how providers are aligning their strategies. If we go to the next slide, yeah. So it's really interesting to see how quick the market dynamics end up shaping the buying criteria globally. While evaluating recent deals, we have observed a reinforced focus on deriving maximum value from their outsourcing contracts. So several critical factors are being considered by buyers. First is the focus is on pricing and contracting that not only meet cost expectations, but also achieve buyers' long-term financial objectives. Second, the solution must fit the organization's quality goals and delivery model. Third, it's essential to choose a provider with a proven track record and expertise, ensuring they can deliver the required services reliably and effectively. I think fourth is the strategic alignment is key. Both parties must work towards shared goals for mutual success. Net, while concrete metrics are important, these broader strategic considerations are very crucial in making a successful outsourcing decision. Ricky, I think one of our audience members had asked a question about the importance of ESG in the EMEA region. Could you share your perspective on this?
Absolutely, I think that's a very valid point, and it's something that comes across in a lot of conversations and with clients of late. I would definitely put ESG as part of my overall solution design and delivery model, as well as the service provider capabilities, right? Because it's no longer outsourcing or selecting outsourcing partners is just not about a transaction, right? It's about a long-term partnership, and it can have a due impact in terms of sustainability, reputation, compliance, and long-term success for the organizations. That's why it's very important that when you're selecting a partner, ESG should be amongst those, especially, and we've seen that fair bit of that happening as well for European organizations. ESG is amongst those top 2 or 3 criteria that they have in terms of them in their mind, to ensure that the partners overall aligns with the overall corporate values and goals. There's a fair bit of risk mitigation planning involved in the overall selection process and the due delivery of services. So of course, I think it's also a fair bit of it is also driven by the investor and stakeholder expectation. So yes, ESG is a very important consideration, especially for organizations in Europe. And our message to service providers is keep it at the amongst the top 2 or 3 criteria when you are designing your solution, and think of sustainability as a very important lever.
Yeah, thanks for the insights, Ricky. So, I think now that we've explored the critical factors shaping buyer decisions, let's do a quick poll. So, here's the question. What is your top provider selection criteria for IT transformation deals in 2024? Your options are pricing and contracting, solution design and delivery model, service provider capabilities, or strategic alignment. I think once we have the results, Ricky will walk us through the insights.
And just to reiterate, we are talking about IT transformation deals over here, which includes something like a cloud transformation or an ERP transformation. Um, Fundamentally different to the managed services deals that we see in market.
Correct.
Brilliant. So we have the poll results, and it seems like um, nearly 42% of the respondents think that solution design and delivery model is the most important criteria when it comes to transformation deals, and followed closely by pricing and contracting and service provider capabilities, followed by strategic alignments. I think this also reflects in terms of what we're seeing in the market. And if you just move on to the next page, uh, fairly aligned, right? Even what we are seeing in the market for transformation. If you look at the bottom part of the slide, when it comes to transformation deals, service provider capabilities, solution design and delivery model, those are very important criteria or considerations for clients when they are choosing a partner for transformation services, right? Typically, we've seen that clients do not want to be considered. They don't they the pricing contracting is important, but it's more of a hygiene thing. They will not compromise on the solution design or the quality of the solution if they believe that the cheapest solution is going to give them some burn going down the line. So they're going to be very risk averse when it comes to transformation deals, and that's why showcasing your capabilities in the right spirit, creating a very strong solution which is strongly aligned with what the client really needs, and not getting fixated by trying to fit everything into a particular type of operating model, or a view of the operating model that you have as an organization, right? Trying to align with what the organization, what the client really needs, that becomes paramount. I think I'm going to just double click also on strategic alignments. I think these are things that you cannot really, these are things that client vendors or enterprises do not ask their vendor service providers to fill in a form, right? They are typically things that are typically perceived when, say, the provider executives are in a room. For example, subtle things like how quickly or how responsive are the service provider executives to, say, certain questions or certain adjustments to the scope or certain incremental changes that they're asking to make, right? So the vibe that the provider executives give in the room, that's what you would probably fit into the strategic alignment bucket. And you cannot have a provider fill in a document or have a response against that. It's something that they perceive and sort of subtly relate to when they are working through the RFP process or through the sourcing process with a particular vendor. And if you look at, however, if you look at managed services, given that if we just stay on the previous slide for a second, if you look at managed services, um, the trend is slightly different, and Webov did cover some of it, right? Where we spoke about how managed services deals have shrunk over the years by nearly 15 to 20% over the last 3 years. And I think a major part of it, thing as Webber mentioned, is around higher offshoring, low leverage of low cost locations, and automation, right? Automation is a big story. So that's why managed services, and enterprises also realize that for a lot of them, keeping the lights on, pricing and contracting that becomes very important, followed very closely by solution design and delivery model. I wouldn't say that they would compromise the solution to get a cheaper quote, but then pricing and contracting becomes the sort of the number one criteria, followed closely by solution design and delivery model, of course. And I think there were a fair bit of questions that we had from the people who were attending, some questions submitted as well in terms of how Gen AI plays a role in this, and we'll talk about that as well in the subsequent pages, followed closely by service provider capabilities and strategic alignment. So yes, again, I think when it comes to pricing and contracting, it would be incomplete if I don't talk about things such as outcome-based deals, right? So even though outcome-based deals, I think everybody wants to talk about it. Everybody just loves having a conversation about it. The reality is that only 10 to 15% of the deals are actually getting contracted basis on the basis of outcome-based deals, right? Because it's hard. I mean, it's hard to actually put those things into contracts, and there's a fair bit of legal paperwork that typically lawyers on both sides won't agree to, right? So, uh, say if I have to say 95% of the conversations start talking about outcome-based delivery, only 10 to 15% of those actually get contracted in paper, right? And in fact, to the contrary, we've also seen big four firms who are doing showing a fair bit of aggression in the market are actually offering some of this in some of their deals as well. So that's so we know when it comes to pricing and contracting, we're just not talking about being the lowest cost vendor in the room. We're talking about the flexibility, the commercial articulation that you bring to the table, the transparency in pricing, the skin in the game. So that's what the whole commercial value proposition is, what we're talking about, and not just being the lowest cost vendor in the room. So the story is very different for managed services as compared to transformation. Let's move on. Yeah. So I think Prateek mentioned about bot, right? And given that this is one of the key themes that service providers are tapping this year, there's a fair bit of activity happening in the marketplace where service providers are assisting enterprises on helping them set up GCC centers in low-cost locations through the bot model. I think one fundamental thing that we've observed through the last 12 to 18 months, having been part of a lot of these transactions and deals, is that service providers assume that bot deals are very similar to a traditional outsourcing deals, and that's a very big mistake in our opinion, because there are very fundamental differences between these two kind of deals. And I'm sure and we've spoken about it in a lot of our other previous webinars as well, but it's good to reiterate here as well, right? Classical outsourcing is very much focused on execution, compared to advisory capability, right? It is expected that the provider will have very high levels of ownership through the engagement. You need to be able to say convey to one to two commercial models, apply typical operational SLAs, XLAs, OKRs, and so on, right? And typically it's an arm's length type sort of a focus on building talent practices and culture in the delivery organization, right? So the enterprises typically do not want to get sort of very deeply involved in what goes on in terms of the talent practices and culture. And that's what is fundamentally different when it comes to BOT deals, right? We think about with a very strong focus on advisory capabilities in addition to execution. The governance model is very different, right? Instead of the two in the box model, you could have a three in the box model. And the expectation is that the provider will start thinking about handover as well, right? That's a very important thing, because and there's a lot of focus around that. There's a lot of focus also in terms of what will the talent and hiring practices be, how will you set the organization culture, what employer branding programs will you run for me, right? And you don't talk about all of this in a classical outsourcing deal. So that's where some of these bot deals are very fundamentally different. And service providers, if they are thinking of bidding for a bot deal, you need to be mindful of how do you bid for these differently compared to a traditional deal. Yeah, let's move on. Um, I think one of the key levers, right? And I think given this is our observation, having sort of been in this market for the last few decades or so. I think in terms of outsourcing or offshoring propensity, we try to rank the different markets in Europe in terms of which countries have the highest propensity to offshoring. So obviously, UK probably came in at the top, and probably I would say and Ireland would come in at top. I think because of the higher market maturity, language considerations, and so on. Um, Followed closely by some of the dark markets, Germany, France, right? Offshoring is gaining prominence in the dark region as well as the Benelux region, largely to sort of meet some of those cost saving and growth objectives. However, given there are certain language and cultural considerations, many organizations continue to prefer to work with local providers in these markets. This is followed closely by Nordic countries, where we observe moderate to high outsourcing and offshoring favorability. However, to pay GDPR and some sector-specific regulations do pose certain challenges. I think followed at the towards the bottom or end of this chart is really Spain, Portugal, Italy, which are generally low in terms of offshoring. I wouldn't say very low, but yes, compared to the UK and Switzerland of the world, they are slightly lower. Of course, the key difference is the language and the cultural differences. Of course, the maturity of the market is much high, much lower. But then I think that's what is changing from the last, to say, couple of years. We've seen more and more of Southern European organizations as well looking to outsource and offshore due to cost considerations.
Vicky, there is a question that one of the
Yeah.
attendees has asked. And I know there's not an exhaustive view, but where do you think the countries like Belgium, Netherlands, and Ireland would fall in the spectrum?
Yeah, I think Ireland probably at par with UK. I think given
Yeah.
the language proximity, I would say Netherlands and Belgium would probably be very close to Netherlands, slightly being closer to Germany or slightly even higher than Germany. I think the Netherlands is a fairly mature market when it comes to outsourcing and offshoring. Belgium probably closer to France in terms of outsourcing and offshoring propensity. Yep. All right. Let's move on and talk a bit more about yeah, Milan, if you could just move to the next page. Yeah. So let's talk a bit more about nearshore adoption, right? So we spoke about offshoring, we spoke about BOT deals. Let's talk about nearshore adoption, right? So generally speaking, I think, and so if we were at a conference a couple of weeks ago at Porto, and one of the key themes of the session was really about how is Europe at a crossroads, and what role does Europe have to play in terms of this global delivery model, right? And the unanimous conclusion that a lot of us came to was that there is this very strong role that Europe has to play in terms of because of the proximity to the customer, that nearshoring is actually a growing trend, and this is true across organizations of all shapes and sizes across all regions. There's much more comfort in terms of working with nearshore providers who are leveraging tier two cities in Spain, Poland, Italy, Portugal. Portugal, for example, I've made multiple trips to the country this year and see a fair bit of activity happening in markets like Lisbon, Porto, and some of those other cities. And there's a key differentiator. And this acts as a key differentiator in IT services deals and are gradually expanding into the onshore European locations. Even if we look at sort of the how does the pyramid mix look like, right? Because if you sort of look at the offshore based deals, you can probably expect that what the pyramid will look like. It'll probably be about 80-90% of the staff will be based out of low cost location. It'll be sort of a top heavy, or sort of it'll be a bottom heavy or a middle heavy pyramid, depending on what kind of work are we talking about. However, when it comes to nearshore, we observe a slight difference in terms of how the pyramid will look like, especially in Europe compared to the North Americas. The onshore pyramid for Europe is slightly more heavier at the top, right? Slightly more heavier at the top and more middle heavy. And this is because of, again, different regulations, compliance considerations, wanting to be more closer to the customer and putting in some of your more tenured people on the account compared to North America. And that is why we observed that's why this is the key observation that we've seen for some of these European based deals. So in terms of the sort of the overall ADRs or the average daily rates, it's if you kind of try and compare India versus nearshore sort of base deals, there's like if India is at 100, nearshore is about 160 to 200 at an index level. So, Pratik, to you, I have this question. I think just curious. So, even at a 60 to 100% ADR premium for nearshore, do you think clients are okay or willing to pay this premium given all the benefits we spoke about being closer to the customer and the language and cultural proximity?
Yeah, I mean, I won't say they are always comfortable with having a nearshore component in the mix, but at least the matured outsourcers, they understand the rationale as well as importance of having nearshore element. And as you mentioned, cultural alignment, language, reduced time zone difference, and local presence, they always, outweigh the associated higher cost. Key point to note is that in a broader deal, right, in a broader deal which has onshore, offshore, and nearshore, the nearshore component is almost always carved out from both offshore as well as onshore. So as to keep the cost low. A myth that is prevalent in the industry is that nearshore is a replacement of offshore. That is not the case. We have seen some of the leading providers to carve out that component from both offshore as well as onshore to keep the overall cost low. Plus, as you would understand, many times nearshoring is the resultant of compliance requirements. There are a few industries wherein, because of certain compliance, you need to have local resources or resources in the same region. So, speaking of industries, we are also seeing pricing to vary as per industry. So, on the next slide, we are going to talk about how clients in specific industries are willing to pay premium compared to others. Right? This view that is being correctly displayed, it depicts the placement of various industries within the broader market pricing spectrum. And it's important to understand that nothing is set in stone, right? The pricing is also impacted by multiple other factors. There could be client-specific nuances. There may be scope differences, but assuming everything to remain constant, and if you were to just plot the pricing observed in various industries for similar types of services within the market spectrum, we do see that placement to differ as per service type. And I'll give an example. In application services, industries such as insurance, telecom, CPRDT, these are the ones which fall at the lower end of the market spectrum, which means that versus median, assuming median to be indexed at 100, the pricing of industries that fall at the lower end of the spectrum are roughly 5 to almost 15% lower. On the other hand, sectors such as public sector or healthcare and life sciences are the ones wherein we do see premium pricing being applicable. And by premium pricing, I mean a premium of 5 to 17% over median pricing. Again, there are a few sectors, for example, insurance, wherein unit pricing is lower because of the sheer volume that is observed in that industry. Likewise, if I talk about telecom specifically, even retail to some extent, these are the sectors which are distressed recently. So, there are some sectoral nuances which is causing this placement to vary. Within cybersecurity services, we see slightly different, placement. Telecom still falls at the lower end of the market spectrum, along with technology and media and travel and hospitality. Travel and hospitality, by the way, is another industry which is considered to be a distressed one over the past few years. On the other hand, banking and financial services, HLS, manufacturing are the ones wherein, at least in cybersecurity services, we see slightly premium pricing. Okay, with that, let's jump on to the next slide. So over here, we are going to talk about a case example on how one of the service providers was able to secure a competitive bid by aligning its solution with the client's objective. And solution alignment is one of those factors which Ricky had highlighted as one of the important ones, at least in competitive opportunities. Over here, while this was an ADM opportunity, application development and maintenance opportunity, we were assisting the clients with the proposal reviews of various bidders in that opportunity. The potential TCV was more than 100 million euro. And one of the global service providers, it went on to win the opportunity. And we could clearly see certain distinguishing solution elements in their proposal. If I were to talk about key highlights, first and foremost was in terms of alignment with their client's objective itself. So the clients had clearly stated that they are looking for a vendor which can assist it in an increased innovation. Now, this service provider had proposed an operating model which was aligned to DevOps. It had proposed T-based teams so as to address the increased and quicker innovation-related asks. The second element which was different was in terms of AMS TCV reduction itself. So they had committed to save more than 30% on top of the baseline spend, right? In the first year itself. So this 30% saving is not over a deal term. It's the saving that this service provider was bringing in the first year itself. The service provider had done its groundwork to identify the channels through which it was going to achieve it, and had clearly stated those in its proposal. So good groundwork, clearly highlighting those avenues in the proposals was also distinguishing compared to other proposals. Not only that, within application maintenance, they had proposed an aggressive offshoring too. With an increased commitment to invest via innovation fund. Plus, it had showcased a strong integrated automation and generative AI story in the overall proposal. By the way, generative AI story is not a differentiator anymore currently, but what's certainly different is the benefit, the incremental benefit that that some of the providers are able to bring in application maintenance and infrastructure management related opportunities. Lastly, with respect to investments, it had shown its intent to have more skin in the game by offering multiple types of sweeteners. So it had offered a extremely well-defined innovation fund, better investment story, and more importantly, an enhanced accountability by having a value realization team. So the objective of this team was to essentially track all sort of deal sweeteners that this vendor was bringing in. So this is one of the deals wherein alignment with clients' expectation helped the provider in securing the bid.
Pratik, if I just stay on this and your point around generative AI, there was another question from one of the audience members, and we can take it, given that we just spoke about generative AI. What's the
Yeah.
trend for, or what's the impact of Gen AI or AI in terms of the year-on-year productivity gains that you observed in the sort of vendors committing to?
Yeah, so generative AI, it's an accelerator which continues to evolve over the past few quarters, and so has been the associated productivity. And if I were to talk about, and since the question was more in terms of the year-on-year productivity gains, I presume it's to do with application maintenance. Within application maintenance, we are seeing more and more use cases being identified by the service provider. And that is also kind of increasing the confidence for service providers. They are able to pass on a slightly higher incremental productivity gain. At least if I were to talk about the leading service providers, they are very frequently offering the incremental productivity gain in double digits over a 5-year AM deal. But that's very normal nowadays. And a very similar scenario is being observed even in the infrastructure management space. So we do expect this uptick in terms of incremental productivity gain via generative AI to continue over the next few quarters as
well. Brilliant.
Okay, I think we can move on to the next slide. So this while the previous The previous case study talked about how one of the service providers it secured a competitive opportunity by offering unique solution element. This one is a case study related to enterprise side. So this is one of the case examples on how enterprises are proactively identifying value leakage opportunities via external benchmarking exercise. So this from a globally renowned footwear company which had roped us in to help them with the review of an ongoing AMS engagement with one of the leading Indian heritage providers. The client essentially wanted to understand the potential areas of value leakage across all areas separately, and which could internally help them with the negotiation in the anniversary of that deal. So again, an AMS opportunity. And what we did was we came in, we understood the entire scope, we assessed the volumes that were there in any company, industry, region specific nuances. Then we did a detailed evaluation of fixed fee. We did a bottoms up estimation of pricing, of effort, and then normalized as per the KPIs and SLAs that were there in the contract, and came up with the best in class market pricing, market sizing applicable for the given scope. Now, using the assessment insights that we had produced, the client was able to better negotiate with the incumbent. In terms of quantum, it was able to save more than 10 million euro over a 5-year deal term. So it clearly is one of those case studies wherein provider was able to identify a significant gap in terms of the value that they can potentially achieve with the pricing that they are paying. Yeah, I think with that I'll hand it over to Vicky to summarize some of the key session takeaways.
Yeah, brilliant. Thanks, Prateek. So if I just have to recap some of the key things that we discussed and some highlights from this session, right? So growth is coming back, and we kind of saw some data which also confirmed that. It looked, but as I said, early green shoots, but it does look like it'll be a soft landing, unlike that V-shaped recovery that we saw post-COVID. Um, in terms of what are clients really looking at when it comes to vendor selection criteria, solution design, commercials, and when I say, and spoke about this at commercials, when it's not just about being the lowest cost bidder in the room, but also sort of the overall commercial value proposition, your the ROI story, the transparency, skin in the game, flexibility. Those parameters are as important as the overall price when it comes to vendor selection criteria. We're also seeing, and then just sort of to add to this, I think a fair bit of conversations around XLAs. I think, again, going back to some of the conversations that we had at a user conference in Dallas 1.5 months ago, I think, and sort of similar conversations in with the European clients. I think a lot of organizations, a lot of clients have complained about the quality of the services that they're getting from their service providers, and I think that's why the conversation around XLAs is becoming increasingly important. I think, having said that, it's not to say that we're seeing XLAs being embedded in each and every outsourcing deal that we are seeing there, but definitely much higher than compared to what it was last year. It's still very small, maybe around 5 to 15% of the overall market where we're seeing XLA being linked to commercials, but it's definitely increasing. So, and to differentiate, we're not just talking about XLAs as just another KPI. We're talking about XLAs where there is skin in the game for the service provider to actually improve experience year on year. Finally, I think despite the organization's focus on preserving value and savings, right, and maybe may have given the impression that it's all about cost and it's all about price, given that all organizations are constrained by cost, there is and we are surprised to look at this. There continues to be a sort of fair bit of value leakage that's happening in outsourcing contracts, and which is just beyond for reasons which are out of line rate cards, right? Because when organizations think about, oh, we need to sort of renew or review a contract with a partner, everybody just thinks about rate cards. But then you need to go beyond that and start looking at things such as offshoring, pyramids, your automation commitments, Gen AI, and things like that, right? For example, even simple things like COLA and FX, we see a lot of value leakage even there from an enterprise perspective, not having lopsided COLA or FX clauses in your contracts, especially given the amount of inflation and FX fluctuation that we're starting to see come back in some of the markets. It's very important to get some of those things correct in your as you kind of think about renewing or refreshing some of your contracts. So those are the few key session takeaways, and we want to take a few questions as well, which were asked during this session for the next 8 minutes. So one of the questions that we had is, Pratik, maybe you can take this. What's the outlook for Middle East and Africa over 2025?
Yeah, I'll talk about Africa particularly. No, Africa is primarily leveraged for business process services and contact center services delivery. I would say the maturity for digital capabilities isn't as strong as some of the other nearshore locations. Albeit, digital capabilities are definitely emerging, but currently they operate on a very small scale. And if I were to talk about a few specific countries within Africa, it would be South Africa and Egypt primarily, wherein we do see slightly higher, or rather better digital maturity compared to other locations of Africa. Egypt, in particular, is frequently being leveraged as a nearshore location by many Middle East clients. But overall maturity in Africa, I would say, still low.
Got it. And in fact, just to add to it, I think this is coming up across in a lot of conversations. Even the couple of weeks event that we were there in Porto, even there, Africa was one of the big conversation points, right? Because of the overall population pyramids that we have in, say, Asia Pacific and in North America and in Europe, and compare it to Africa. 25, 30 years down the line, or even slightly below before that, I think Africa is going to be the next big hub for talent availability, right? Because of the population pyramid. So that's why I think we see a lot of excitement around that. Again, there are a lot of challenges to solve for before we get there, but and that's why we kind of have a crystal ball and looking at probably a decade ahead or so. Weber, probably this question, you probably best be answer this. I think, what are some of the innovating pricing models to drive successful workplace services contracts in Europe?
Right. So, Ricky, I think inherently most workplace contracts still follow a fixed fee or output-based models, right? But recently, there's been a shift to outcome-based pricing in some contracts, linking payments to results like productivity or satisfaction. As you also mentioned, in workplace deals, we have seen XLAs being predominantly used. So they are not just metrics now, but they are linked to penalties. But what we have seen is that organizations don't implement this in one go, but have a stepwise approach, right? So every year they kind of increase the penalties linked to XLAs. So this is a approach that we see in a few digital workplace services contracts now.
Got it. Okay, there is one more question on GCCs. Again, it goes back to so how is the GCC growth theme for EMEA clients? And the question says, are these clients ramping down their India GCCs? I think the answer at the outset is definitely no. We showed the chart earlier around 300 new center setups in over 2023, and more than I think nearly 32 of those actually were in India, were by EMEA headquartered companies. So just to reiterate, 32 new center setups by EMEA headquartered companies only in India. So there's a fair bit of activity happening. And again, that was in 2023. In 2024, again, we've already till date so far, we've already seen 32, and the number was about 43 center setups in 2022. So it's definitely not growing down. We continue to see acceleration of GCC mandates in India, which means new GCCs are being set up, and the mandate of existing GCCs continue to grow. And on an average, we typically see anywhere between 30 to 50 new center setups in India from clients based out of EMEA. So the answer is definitely there. There is a fair bit of activity. I think Europe continues to be leveraged when you need work within the boundaries due to regulatory reasons, or in case you want proximity, language, higher time zone alignment, and so on. But for everything else, probably India is sort of the number one destination. So that probably brings us to the end of the section. I think I still see a few questions that we've not been able to answer as part of this. We'll definitely, I think some of those are very data intensive questions. We may not have the data off the shelf, but we'll definitely look at those, park those, and come back to you offline with some of our responses. I think there's one last question. Again, where are these GCC centers primarily set up tier one or tier two, tier three cities? I think, and this also goes back to the question that we earlier saw, right? I mean, we see a fair bit of activity happening in tier two cities in India as well, tier two and tier three cities in India, and I think internally as well we were deliberating in terms of how do you define tier two and tier three cities in India, and internally I think we were coming to a conclusion that anything which is outside of Bangalore, Hyderabad, Delhi, NCR, Pune is probably will be classified as tier two, which that includes a fair bit of activity happening in Trivandrum, Kochi, Lucknow, Bhubaneswar, Jaipur, Indore, and all those. I think what's the mix? Hard to say. I think majority of those are still predominantly, I would say a good 70-80% or still predominantly will be tier one cities. And the rest, a small percentage of those will be tier two, tier three. But again, we'll definitely feel it'll evolve over the next decade or so as we see some of these tier two, tier three cities have better infrastructure, better government policies to invest, to sort of incentivize them to able to set up in those states. So that's the state of the market. Uh, just for this audience, again, we are bringing our Engage user conference, which we did in Dallas in October, to London in at the end of March and April. This is going to be a 1.5 day event focused on GBS as well as global sourcing and vendor management executives. This is going to be in London on 31st March and 1st of April. If you need more details, there's a link to the website, and yeah, look forward to seeing a lot of you there. So with that, we can wrap up and close the call. And thank you so much, everyone, for joining us today for this very interactive and engaging session.